Welcome to Morningstar. I'm Holly Black. With me is Jamie Ward. He's manager of the Crux UK Core Fund. Hello.
Hiya.
So plenty to talk about in the UK at the moment. What's it like to be a UK fund manager this year?
Different, certainly. I mean, obviously working from home has changed things quite a lot. The markets seem very unpredictable. I don't think many people would have seen markets only down as much as they are, given what's been going on. But I guess the extraordinary central bank interventions we've seen has pushed a lot of liquidity through capital markets, and invariably that's led to a sort of passive bid in equities. So you've sort of been clinging on, sort of riding the rally ever since the lows in March, which is it's making it quite interesting.
Does that make it difficult to pick stocks because it's not necessarily the fundamentals that are driving them at the moment?
Extremely. I mean, I guess a fundamental is driving them, but it's not your sort of typical value dynamics that you might expect. There are certain equities which, I admire the businesses that I don't own in the fund simply because I can't sort of square the circle of their valuation. So a business like Spirax Sarco, which is one I've sort of followed for a very long period of time, but I look at it on a PE ratio sort of in the mid-40s, which is a business that's been around for 30 or 40 years on the stock market, and it's historically been a sub-20 PE business. So by not owning these things, you handicap your performance, but at the same time you look at them and you think, I can't understand how I can own that and make sense of the valuation.
That's a real quandary. So I noticed that a lot of the portfolio, well, not a lot, but a significant chunk is in financial stocks. Is there a reason you particularly like that sector?
Yeah, I mean, I think it's particularly banking in my case. It's a little bit outside banking, but it is largely banking. I think first thing is investors have sort of looked at the last 10 years and people have been rewarded for not owning banks for a long period of time. And I think it's because a lot of people were sort of burnt so badly in the 2008-2009 period that that people sort of ignore them now. And that's created this situation where I think banking stocks in particular are very, very cheap businesses. But it's a lot more than that, because I think there are a lot better businesses than people think they are. And I look at some of the banks and I think I can see how they can become more valuable. But if I'm buying them in the stock market, I'm getting them at a discount of perhaps 50% in some cases. At the same time, once we get through this period where the FCA is curtailing dividends or actually cancelling dividends entirely, that we could be in a situation where, if I'm looking back in 10 years' time, I think people will be looking at the banks and going, that was such an obvious investment. Why didn't we do that?
I suppose when you think about it, banks are quite a simple business at their core. And what's really capturing people's attention at the moment are tech stocks and disruptors. So where do you stand on that sort of business?
I mean, I'm very, very happy to own those sorts of businesses, but I need to make a case for the valuation as well. And where I find it the more interesting sort of ways of sort of playing that is if you can buy businesses which have divisions that might disrupt an area, whatever it happens to be. And often, because it's a division of a larger business, people don't necessarily pay that much attention to them. So you can sometimes pick up these assets for much more attractive levels as long as you're aware, as long as you sort of assume a valuation for the sort of the rump of the remaining business.
Jamie, thank you so much for your time. For Morningstar, I'm Holly Black.